Will, today we are talking about how to plan your smart fundraise, smarts in quotations. We're using the SMART goals framework. I'm going to get to that in a moment. But I wanted to start off saying we've got these tools and a lot of founders are starting to use them. It's great. Let's philosophically approach this because it often feels like a marathon at sprint speeds. We're told by investors to move fast, break things. We need traction. We even help founders with startup sprints. But at the same time, that can be mistaken for, oh, this is going to happen literally in 30 days. It is a slog, and we just want to acknowledge that. Will, what are your thoughts in terms of this statement, a marathon at sprint speeds?
I think nobody understands what this process is. And why would you? Why would you understand what this process is? I think everybody has an idea of what this process, the fundraising process entails. And that idea is always wrong. Again, Ed, you and I have been through it personally. So this
Oh, yeah.
isn't like, we're knocking other people for not knowing. Two things. Number one, when you go into it, you make some reasonable assumptions. They just happen to be reasonable assumptions about an unreasonable process. Second, until you've been through it and you understand why all this weird stuff happens, you can't really appreciate how wonky this process is. So if you're doing this for the first time, and most of you are, watch closely, listen closely to what we're going to say today, because we are going to save you a ton of frustration by just explaining to you what gets held up in this process, what takes time, why it takes time, how to read the different signals that are out there. There's a lot to this. And this isn't like applying for a mortgage or a car loan where you just fill in the blanks and you submit it and you get the money or you don't. This is way more complex, and I'll explain to you why.
I would add to what you're saying. Time is definitely a consideration, Will.
Yeah.
So many founders come and they say, I need to raise money in 30 days. I have 30 days runway.
Everyone
And
needs money.
exactly. Like
Yeah.
we understand comes from, but really, if you're looking at the time horizon, it's a sprint because you have to move quickly and act as fast as you possibly can on so many other factors while you're trying to build your startup at the same time. But really, this is not going to happen. Let's just get it right out of the way up front, Will. It's not going to happen in 30 days. I'm just ripping off the Band-Aid right now.
Well, it can't. I mean, that's part of what we're going to talk about. Like, this is like, well, I need the money quickly, so I'll just do whatever it takes to make it move faster. Yes, you will do whatever it takes to move for it to move faster. But you are in control of so little of this process. It's the equivalent of saying, I want to get married by the end of the month. Yeah, you do. But that doesn't mean all the other people on the other side of who you're trying to find feel the same way and operate at the same speed. Not only do investors not need to move as fast as you do, but all of the people behind the investors, like the other investors that will come in, the attorneys that will help paper all this up, no one's in a hurry. You're the only person in a hurry. And that's the problem.
While at the same time, you can do things to affect it on your end, but absolutely right. There's a difference between, Will, your sphere of influence and control and your sphere of concern. And founders tend to waste a lot of energy getting concerned. And I appreciate all the questions because a lot of founders would come to me and ask me, is an investor going to think this? Are they going to think that? How do they approach it this way? And I go, it's everything. Yes, yes. And all that in between, a bunch of no's. That's not your job. Your job is to stay in that circle of control and influence and
Yep.
do things the right way. Everyone use the Q&A box or chat to ask questions and just load it up. We are ready. Feel free, abscond this program. Let us know, hijack it, derail us, challenge us, throw it in a gauntlet. We're ready for you. And if you are watching this on the YouTubes, do us a favor, like, comment, subscribe. Always extremely helpful. Well, at the same time, make sure you check out a bunch of our other videos, share them. But you can come to our website. You can try all this for free. Here's a little plug. Will, I'd love for us just to review and overview what the solution is. Now, take it for granted. Most people who are going to be watching this video already know this suite of tools that we've put out there, raising capital. And we're saying, even though we're talking about it's a marathon, Will, the proposition is we're automating, we're removing the friction, all the stuff that can be done for you.
Right.
Tell us how we approach that in terms of what are the parts that we do make 10x faster?
Here's why looking for investors is a ginormous pain in the ass. It's a ginormous pain in the ass because there's a few things you're going to have to do that we all have had to do so many times, and it's just annoying. First thing is there's 250,000 active investors. Active is relative, right? People that are writing checks at all. But you only want to talk to less than 50. The biggest mistake you can make going into this is talking to people who aren't in that 50, bar none. But you could talk to 200 investors, but if they're the wrong fit, the wrong industry, the wrong stage, you name it, you're going to get no's from all of them before you even start talking. Now, if you have no idea who the right people and the wrong people are, think how daunting that is. And most people don't. I didn't for a decade. We figured this out for you. So the first thing we do is we say, okay, here's your pitch deck, or here's your criteria for how you're trying to raise. We'll only show you the people that are relevant to what you're trying to do. Second, we'll then rank every single one of them, from the one that's most likely to be a fit to the one that's least likely to be a fit. So you'll know who to talk to first. For each person that we bring up, for each investor, we'll tell you why this is the right fit. A lot of these folks have firms that have multiple contacts. You can make just as big of a mistake by picking exactly the right firms and contacting the wrong person at every one of those firms. For example, one of those common mistakes people make is, well, I want to talk to the decision maker. I want to talk to the managing partner or whatever. Yeah, but they don't want to talk to you. So you're basically, it's the equivalent of saying, well, I want to work with Microsoft or I want to work with Google, so I'm just going to message the CEO. Good luck with that, right? It's probably not going to work. There are systems in place, there are people in place in order to be able to scan through your stuff and set up these meetings, et cetera. And if you're talking to the wrong person and you're not getting a response, it's because that person isn't set up to respond to you. They're busy doing other stuff. Next thing we look at is, okay, once we have the universe of investors that we want to talk to, how do we talk to them? Ed, when you see a lot of the initial emails that folks compose, how ready are they for prime time? Like when you say the first time you see an email.
I would say 99.9% of the time, they are not ready. Unless you've done it before, there's a myriad of mistakes that founders make in terms of understanding how to send that initial email.
Yeah, exactly. And I think what ends up happening is we end up writing either super hyperbolic stuff, which is like greatest investment of all time. For some reason, whenever people write that, they always write it in caps as if that's the solve. Never use caps. Or what they're writing is like a life story, this long, incredibly detailed email. And it's like, look, I get it, but no one wants to read that email. Get to the point. And so the founder will say, what should I be getting to? What is the point? That's what we'll explain to you. We'll explain to you in the app. We'll write the damn email for you and just say, this is exactly what you're supposed to say.
Because all that can be automated, Will. This is not doing a life's opus or writing a personal autobiography or adding style to it. Investors are pretty used to seeing things cookie cutter, and therefore you can train an AI agent to take care of that for you. Just really quick to put some context to what you shared, Will, I uploaded one of the pitch decks that we've been working with. Thanks, Nana, for letting us use your pitch deck here. But I'm just going to click this button. And really what I'm explaining is that's what everybody should be doing right off the gate is upload your pitch deck. Now, don't send anything yet, but just get used to the system, press the buttons, and you can do this for free. And as you're watching right on the screen, Will, it's going through the investors, and we found 3,797 investors. Now, by no means are you going to contact them all, but as you can see, just like Will said, right? See the 100% matches. We'll walk us through then more of what is going on here.
I think there's a few things. Number one, you're seeing the ranking score and the number of points. It doesn't matter if you understand how the point system works. That's something we did internally. But the point system basically said, based on what criteria you just gave us, what are the potential investors that are the strongest fit for what you're trying to do, aligning by things like geography, by industry, by experience, by stage, things like that. So you're talking to the right people. Then what we're going to do, and so Counterpart Advisors has 4 contacts. Of those 4 contacts, we're also going to tell you which one you should be talking to based on what we know about who is the most responsive, because we send out gobs of email to all these people, and we can track responses. In this case, I guess Jonathan Grath is the most responsive. This used to take us a month to do. So just saving a ton of time. And as Ed mentioned, like you can do this part for free. So just dial into what you're trying to get accomplished and who you're trying to talk to, and at least see who the opportunities are out there. Now, the next thing we'll do, and Ed, if you would go to the part where we're going to compose our messages. The next thing we're going to do is we can save all the people that we want to send messages to. And then we can also generate the messages out to them, which is incredible. We said this a moment ago. Most people, when they go to send out outbound messages to investors, they all get it in their head of what investors want to hear, and they write something accordingly. For example, they'll say, well, all investors want to make money. Yes, they do, but that's actually not what they want to hear. And that's very counterintuitive to people. Like, well, of course they want to make money. Yeah. Every single person sending them an email is with the intent that they want to make money. That's kind of a given. So you will say, you're going to make billions. Like that's what they're in business to do. So it's not like they're hearing another pitch that said, you're going to make hundreds or you're going to lose everything. So what we do is we take the pitch deck and we distill it down to the exact words, the exact focus points that the investors want to hear. So we'll do that for you, and we'll write the entire email. Now, you can change it, you can change the tone of it, etc. But what's cool about this as well is we can even send this email on your behalf. We can connect it to your Gmail, to your work email, etc. This will come out as a natural message being sent right out of your own inbox. You can look at it in your sent folders, and when they hit reply, they're just replying in your regular, natural inbox. We are not in the way whatsoever. We just help you, but we're not in the way.
Let me talk about trusting the system. Because first snag, I work with founders, Will, and they say, no, I want to write the email this way. This is more personal. This is more me. And then they get in there, and we've had this happen multiple times. And some people have even verified the data coming back and saying, yeah, your previous email, Ed, the way that you wrote it got better responses and better feedback. Well, we've trained this with the best practices. And that's why I say, trust the system, trust the process.
Yeah, yeah. And the thing is, you can make the email whatever you want. If nothing else, go in there right now, drop in your pitch deck, and see what the email says to like prompt you to go, oh man, I should have talked about traction. Or, oh, I see what they did with the subject line. That's clever. We built an AI. We spent technically 20 years, but the past year and a half refining this AI in order to get this product out so that it would always write a really high quality email. And we're not saying don't change it. We're saying start with that and modify it to what you think it should be. But it's a great start.
Well, we're going to talk about expectations versus reality. And this is kind of a pep talk that I want to have up front. And like you said, Will, the reason we wanted to record this video for years is because so many founders they're running the marathon and they're thinking, I'm in this for the long haul. And then they start to sprint, and rightfully so. And then they run smack dab into the wall of their expectations, which I just say are predisposed or predetermined disappointments. And if I had my way, I would make every founder sit down. I'd say, what are your expectations? And go through every one of these. And that's the reason we're recording this video.
Yeah, and like I said, founders come to me, they come to you, and no founders ever come to us and said, hey, you know what? I would love to have capital in the next 2 years. Everyone says, I needed capital 2 weeks ago. 2 months ago, like I need it today. This isn't a merchant cash advance, right? This isn't a payday advance where you just show up and like a day later you have money. It works nothing like this. However, once you understand what the process is, you of course would like your money sooner, and we all would like to see it happen. But it's super important to understand what you can control and what you can't. So let's dig into that, Ed.
Just quickly qualify. You've raised tens of millions of dollars for your startups. I've raised hundreds of millions of dollars, not for my startups, but including other startup funds, as well as I've been the general partner, and I've sat on that side of the table, but also worked with founders to help them raise hundreds of millions of dollars, and they've gone on to raise billions more, either through the public markets or their fundraise on their own. Give us a bit of context in terms of the history and why you've created these tools the way that you have based on all that experience.
I've been doing this forever. So this is my 32nd year as a startup founder. I've done 9 startups myself. I bought 6 venture funded companies. I have been on both sides of the transactions. I've sold 5 companies, the most recent one being last year. And I've helped founders raise over $1 billion. Now, with that, I've spent so much time with so many founders going through this process for decades. And you start to see patterns. You start to see when a founder starts going down the wrong path, you're like, that fails every single time. And so you kind of reel them back in. So our goal with what we're building, the tools, or really even all the Startups.com platform, was to be able to say, hey, this is the most realistic path that you can go down in order to try to raise capital. And I say try because it's not a given. You are competing against hundreds of other startups for that one check, right? For that one check. Meaning for every 500, I'm making up this number by the way, for every 500 startups that will be applying, being out there pitching, maybe one will get a check. The other 499 will not. Now that doesn't mean that your chances are so small, because really a lot of those other 499 should have never been trying to raise capital. I mean, there's a lot of not bad actors as in bad intent, but like low quality asks out there.
Exactly.
So the first thing to do is make sure that your presentation in your startup, of course, are in that top 10%. So you have the best shot.
Will and I are not gatekeepers. These are not our personal contacts, not our friends. We cannot affect your fundraise. We don't withhold for some nefarious reason to try and get you to pay more money or be a member even.
Yeah.
It's a tool out there to maximize your opportunities, optimize what you got going on. Because, Will, I'll just be straightforward. A lot of times founders get disappointed and then they come look at us and say, you said that I could raise 10x the capital and 10x faster of the time. And it's like, we've done something to prevent that from happening. We can't affect that.
Yeah. So let's dig into that a little bit, because I think it's really important. It goes back to what you can control and what you can't control. And there's nothing we can do to change certain outcomes. Here's what I can control for. And this is what we spent a lot of time and many years working toward. I can control for what you're saying, meaning what your pitch deck looks like. So that doesn't mean that if you do everything right and you check all the boxes that you will get funded. It means that if you do everything wrong, you probably will not. I can't guarantee that you will get funded, but if you go down this route, I can almost guarantee you will not get funded.
Right.
So doing it right doesn't guarantee success, but doing it wrong more or less guarantees failure. Okay, so the first kind of trap to avoid is all the dumb stuff that we all do in order to kind of guarantee our own failure. So we take that off the table. Cool. Next step, you're going to go out and talk to investors. My job, our job collectively, is to make sure that the people that you're about to talk to are relevant to what you're going to do. Now, that said, they're still people. They're still people. It doesn't mean that if you say all the right things and your pitch deck is perfect and you talk to the right people, that money is just a foregone conclusion. That's just not the way this works. You can say all the right things. You can have the perfect deck. You can talk to all the right people and have them still not like your deal. That happens all the time. So I want you to understand this isn't the equivalent of applying for a mortgage where if you check all the boxes, if your credit score and income check out, you will get a mortgage. It doesn't work that way because the X factor on this one is we're all competing for the attention and opinion of an investor. In this case, many investors. So we've got to be mindful that while the tools put you in a better position, it's still your job to get this thing over the line. We couldn't change that outcome if we tried. Even if we said we're going to make personal introductions to every investor, that doesn't do you any good. You still have to be able to get in front of them with a pitch that they're willing to buy on. So again, we can only take it so far.
I love how you started this. You've dropped so many nuggets. So let's organize them so that we can really bring this home. So expectations versus reality. So we're using a SMART framework and everybody sets out with some goals. And we say, first, you want to be specific. So let's talk about how specific do we need to be? For example, how much are we going to raise and what we're going to use that money for? How specific do we need to get our pitch deck in general for that initial reach out, that outreach, that initial impression? Walk us through how to be more specific so we do this in a smarter fashion.
This is usually where we miss on the pitch deck. We miss on the pitch deck because a lot of times when we get started, and I know some of you are in the audience, you've worked with me and Ed, and you've been through this process. We start really big and amorphous and confusing. I had a founder that I talked to last week that has such a good idea. When he pitched it to me, it was terrible. His pitch was terrible, right?
Yeah.
His idea was great. The founder was great, right? Which is all that matters. But the pitch was so bad. And I say that with love, right? Like, I get it. My job is to help with that. But I said to the founder, I said, look, you have this great idea. You're exactly in the right place at the right time with this, which is rare. But what you just said, like how you just expressed the problem, the answer, etc., was so cryptic and so hard to understand that you made it impossible for me to want to buy. And the founder, and I explained it, and I detailed it, and I unpacked it. And the founder was like, damn, well, now that you put it that way, that actually does make sense. No wonder I've been having some trouble.
Sure.
A lot of this comes back to, let's just talk to somebody, founders in the audience. Let's talk to somebody about my pitch, about my idea, about my game plan, and see how well it holds up.
The way to be specific, everyone, is to be clear and concise versus cute and clever.
Yes.
Right. And so many founders think, well, I'm going to get, and they don't go out to sabotage themselves. They get cute with it and they try and be clever and they start adding all these words. But the expectation, Will, is that, the investor's going to get it. I'm going to throw it. They're going to read my mind and they're going to exactly know what I'm trying to raise and all those things. Like another big faux pas that, I've caught is raising between $1 to $3 million, right? We're just going to throw it out there and the investor's going to figure out, we're going to negotiate. Now, from a specificity standpoint, and a lack of clarity, an investor just talking about this thinks you don't know your numbers. You don't know your unit economics. You don't have a financial model. You don't know where you'd put my money. So you're just thinking that I'm an ATM, that you're going to come and maybe withdraw $1 million and then later on draw another $1 million.
Right.
And that's just not working. So what you're talking about is really sharpening the tip of the arrow with your story, your pitch deck, and making sure the investor gets it with clarity in the first literal 30 seconds of seeing that cover of your slides.
The guy I was talking to, and I'm not giving anything away by saying this, we never reveal the entrepreneurs we're talking to. When I said, hold on, let's just zoom out. Explain to me again what the solution is. And he just said, analytics. And I was like, that makes no sense. It's like, you've been telling people that? And I'm kidding. I'm laughing with them about it, right? And I'm like, you can't just say that. Like, that could mean literally anything, dude. Like, you have to be way more specific about what this product is and how it works. And again, great product, great founder. So no issues there. But sometimes the way you're conveying what's in your head is actually confusing your audience versus selling them.
It's so clear in your head all the time, Will. I fall in this trap all the time. Let's look at the next one here. Measurable. Now, this is an interesting one because a lot of founders just go out there and they just throw it into the ether. But it's super important. When I say measurable, I mean, can we actually measure your startup in terms of the traction, in terms of, Will, we talk about this all the time. In your problem statement, talk about the measurable costs that this problem, causes. And that's going to give the investor a dollar figure in their mind that, oh, okay, this is a worthwhile problem. We're going to make a lot of money. I need to invest in this. But the expectation is, all right, I'm just going to put out just some unclear numbers. I'm not going to be specific. And also, I think a lot of founders think the investors aren't going to get in there and measure everything. But the reality is your startup has to be measurable to warrant an investment.
Agreed. And I think in the formative stages, measurable becomes very convoluted to folks. Measurable, and I think a lot of what you're talking about is traction, right?
Absolutely.
Like some sort of measurable progress that shows the investor that you're doing something meaningful. Now, in the early stages of this, you're doing very small things. You've gone from 1 follower to 10 followers. Now, to be fair, that's a 10x increase, right? The great thing about starting with small numbers is it takes nothing to make them big numbers. Those little bits of progress, even though they may seem small to you, are exactly where formative stage startups begin.
Huge for investors. They love it. Well, we have a founder we mutually love and adore. And what I love is he measures his traction and he comes in and reports it to me. And he came to me one meeting and said, Ed, I got my first paying customer. Okay. But not only that, I tested monthly versus lifetime. That customer paid for lifetime. And then I said, all right, how did you get that customer? And he was able to tell me the unit economics, how much he spent. He measured everything for the one customer.
Yeah.
And I tell founders all the time, if you know how to do this with one customer, you'll know how to do it with millions of customers and millions of dollars.
Ed, one of the ways that I do this in the formative stages of a startup or when I'm launching new products, a lot of people don't know this, is I get on customer service. So in the formative stages of Startups.com or any of the startups I've done, if you ever got in a live chat with the operator that's going to be with you soon, that operator was me in almost every case. And I found it was the best way to get real-time analytics from your customers, right? To find out exactly what their objections were in real time. And the reality is that they weren't going to stump me. And I say that to say, like, I have the product knowledge. So if they're asking about some version of the product or something that they need to get done, if I don't have an answer for that, then no way in hell a rep that I was going to put on this chat was going to answer it better. More importantly, everyone's telling me why they're not buying, right? And I say this to say, in the formative stages of a startup, getting in front of customers and finding out why the no exists is an incredibly powerful and measurable stat that you can convert into how to get to yes.
And make sure investors understand when you put in your pitch deck, don't just say we made $1 million. There's a difference between making $1 million over the past 3 years and a difference between making $1 million by growing 10% week over week for the last 3 months, right? Yeah. Big difference. But question for you, Will, how important is it to measure? Because our system does feature these analytics in terms of measuring investors, how much they open, how many times they click, the campaign in general. What's important about measuring that?
Okay, so I think this is where it gets a little bit funky. I want to point this out. So talked to a founder last week, and he came from the sales world, which is fantastic because for those of you that have a sales and somewhat marketing background, the outreach process of fundraising actually mirrors a customer or sales cycle. Very much so. A lot of that looks like what's the top of my funnel, what stage am I moving people down the funnel, as long as contact, interest, etc. And this founder understood that very well because they came from enterprise sales. And they said, well, Will, wouldn't it be the case that the bigger I make the top of my funnel, just the more investors I dump into that, the more people I'm going to have to talk to? And I said, absolutely not. It doesn't work that way. That only works if every person you put at the top is relatively the same as far as how they align with your product, being your stage, your industry, et cetera. So if you start to load up a bunch of people in the top of that funnel that aren't in the stage that you're investing or raising in, like pre-seed, seed, et cetera, or not in the industry, or don't invest in your geography, et cetera, the efficacy of the number of people that are going to respond or open drops geometrically. I would rather have you have 50 people in the top of that funnel that are spot on with who you should be talking to, and you reach out to those people first pass, and you say, hey, Will, I reached out to 50 people. The system reached out to 50 people, however we do it. And I only got one response. I'm like, okay, that's not ideal. It's not ideal, but it happens. Now let's talk about a next level strategy for the next 49, right? We're not just going to keep hammering them with the same message until they somehow respond. What can we say differently? How can we change the message? Maybe we should try a different contact at that organization. When I used to be in the ad business, when I used to be in the advertising business, I would go after big clients. Typically, you'd go after the chief marketing officer or somebody with that kind of rank and title. They'd be very hard to get a hold of because everyone was trying to get a hold of them. So I would look for other inroads. I would look for a lower level marketing manager and get in through there. Sometimes I'd call into IT because we did a lot of web design, et cetera. And I would talk to the chief technology officer, somebody at that level. Sometimes, because I'm a weirdo, I would go onto LinkedIn and find out who were all like the low level people in the organization and
Right.
email them directly. Not all of them, one of them, because I knew they'd respond to my email because they
Yes.
never get emails from anybody. There are lots of ways to be able to get an inroad. And we have to look at this funnel as lots of different ways to be able to get to the contact we want.
Measuring along the way, a founder contacted me and said, I've sent out to 10 investors and they're the top of the list. No one's responding. When are they going to respond? That's was the message, right? How do you respond to a message like that?
There is an expectation that just because you sent out a message that someone wanted to receive it. You have to understand these folks, these investors specifically, are getting hundreds and soon thousands of messages from people competing for their attention. The idea that you sent one message to one person and they didn't drop everything to respond to you is bananas. Okay.
Right.
That's why we have to be persistent. We have to go in multiple times. We have to go in from multiple angles, look for different people that we could talk to in the organization. If the one person isn't responsive, these people, their job is not to respond to you. And the best example I can give, and I think this helps a lot of people, is think about it when you're applying for jobs. You're like, I applied for 10 jobs and nobody's talked to me because they don't have to. Because they got 350 applications for that job, right? The only people they're going to talk to are the people that they absolutely need to talk to right this second. They're not going to email every single one of the 350 people and say, sorry, I couldn't get your message right now, or sorry, you're not a fit for this, right? The investors are only going to focus on who is most top of mind. And in many cases, no one at all. They're just too busy to answer any of these emails right now because they're focused on getting other deals done. There's a million reasons for them not to respond, and none of them are your fault, by the way, but we have to be persistent about this.
Next up, Attainable. Well, there are a few things here. I see founders, and I've given feedback, for example, try and raise $6 million for a consumer product without any MVP prototype. It's just at the idea stage.
Mm-hmm.
And I said, I think you're going to have some difficulty, not saying it's a total 0% chance. Everyone has a better than 0% chance of finding that one founder that says, great, but it's just not realistic. And I think a lot of founders, they imagine investors having all this money. You got a $50 million fund. You got all this dry powder. Of course, you can stroke me a $5 million check at my stage. But there are levels in terms of what funding is attainable. And so expectations versus reality, I think it's important we address this.
Well, it's a couple things. Number one, investors don't write that many checks.
Right.
I just want to be clear. Now, when I say that, there is a massive spectrum of investors, over 250,000 in the US alone. The qualification to be an investor is very, very low. So there's a massive number of people at kind of the bottom of that stack that aren't really all that active or useful. But my point is, for the folks that are in like the top 10%, the kind of the most active, maybe names you've heard of, they're not writing that many checks. You may have heard of some like a Techstars or Y Combinator that are writing like a few hundred checks at a time. That is total anomaly. And like they're the only people that get to do that. And if you get into that program or you go that path, awesome. But you're still talking, even with all those checks, hundreds of checks. Okay. To put that in perspective, we have 25,000 companies a month that come to us at Startups.com, and we're a tiny microcosm of the overall startup marketplace. So imagine how many people are looking at any given time. So if the biggest check writers are writing a few hundred checks like twice a year, maybe, then everyone else, like most investors, are going to write between 5 to 10 checks at most per year. Think of how few, it's like barely one a month, but they're going to get pitched by thousands of startups every month. So the ratio there is incredible. Now, the key for you, I don't want you to sound dejected either, is you have to find the right investor at the right time, meaning they're all investing at different times in different deals, and you have to find the one for you. I just want to make sure you understand that it's not, there's, $1 trillion at play that's looking to get invested, and you're just going to get your portion of it. Not quite, it doesn't quite work that way.
It's also the size of check, Will, expectation versus reality, that so many founders think $1.5 million pre-seed is completely attainable. And while there is the possibility, as a general partner doing the analysis, many times, and this happens more than not, and this is just, I'm letting you founders know, I'm just totally popping the hood, letting you see behind the curtain. We would be interested in an idea, the founder, everything checks out. And then we see this outlandish ask slide, asking for all this money at the wrong stage. The assumptions in terms of just even the buckets, and we're going to be paying ourselves $250,000 a year in our salaries. Yeah. Here's what we're offering. It's like Shark Tank. We're offering, 10% of our company for $10 million type thing. Yeah. And that's been the deal breaker. We suddenly get turned off. It leaves a sour taste in our mouth. And that's the reason founders managing expectations versus reality on how much funding, when it comes in, what's attainable versus isn't,
Yeah, and what's the
is an
process to do
important
it?
step.
Yeah, and look, we want you to raise the money. I mean, that's literally our job, is to get you to raise money. What we're concerned about, and the whole premise of what we're talking about today, is just just so you understand what you're competing with, understand what you're getting into. I'll give you, one analogy there, Ed. I used to run a website and a company that did casting for television in Los Angeles.
Yeah.
And every single person I had known in that era, it's like mid 2000s, reached out to me like, I absolutely want to be on television. I get that, which is awesome, right? My job was to try to like find people that we could put into the major networks on TV and stuff like that. But what I would say to them is, so does everyone else, right? Like,
Yeah.
why is it you versus all of the other people that kind of want the same thing? For us as founders, we have to be that unique thing, that gets us cast, so to speak, or invested, unlike everybody else. I raised venture for my last 3 companies, and it was hard. Well, the last one was actually incredibly easy, but it was a fluke. But for the other ones, it was hard. It was a slog, right? And I got told no way more than I ever got told yes. And I say that to say, I had no idea it was going to work or not, but I was pretty persistent. And I think if you get a few no's, like if you send out 10 emails and you don't get a response, and you're like, oh, I guess this isn't going to work, it's not going to work for you. It's going to be a long slog if you think that's how it's going to work.
By the way, everyone, Will is, I think, the only person on the planet where I would have loved to have been his co-founder on every single venture that he's gone on, because any of you, if you get a chance, sit down with Will, you get a chance, buy him a beer and listen to his stories. It's fantastic. But I digress, Will.
Yeah,
I digress. And this is the gift that we have here at Startups.com with all the experience, all the people here. Let's talk about relevant. Will, you've touched on this so many times. But make sure that you're pitching the investors that are relevant to you in the right industry, the right stage of funding. Be relevant, and you don't need to pitch hundreds of investors. The top 50 relevant order, that's where you want to start.
I learned this one the hard way. I learned this the hard way. I've just banging my head against the wall for like 6 months straight. I mean, nonstop every day, reaching out to investors, taking meetings, and getting no after no after no. And I could not figure out what the hell was happening. Now, a couple things. Most of these were warm introductions. Okay, so this wasn't me cold calling. These were a founder that I knew or an investor that I knew saying, you should talk to Redpoint, or you should talk to First Round, or you should talk to whomever. And in my mind, I was like, okay, this makes total sense, right? Like, I'm getting introduced to this VC and I'm pitching them, and they're all telling me no. Now, here's what I didn't understand. I didn't understand that the round that I was raising in, I was doing a pre-seed round, they don't invest in. But I didn't understand is I was doing a fintech startup. They've never done a fintech startup, the ones I was talking to at the time. And I kept getting no. And then as soon as I talked to an investor that did pre-seed investing in fintech, which came way too late after like 50 bad meetings, all of a sudden that investor was like, oh, this sounds amazing. Now think about if I had burned out at number 10 and I was like, everybody just thinks this is a dumb idea. And maybe it was, right? But my point is, had I just kept talking to the wrong people, I would have gotten the wrong answer. And that would have been 100% my fault. So not knowing who you're supposed to be talking to, even just the basics, like I said, the stage, the industry, location, etc., is a huge miss. Most founders I know are out there pitching and talking to the wrong people.
Let's talk about general LLMs versus LLMs that have another layer on top that we've actually trained. We try to give you as much information to make your fundraise as relevant to the people. And we've talked about this before on other episodes, Will, but I've had founders come back to me and say, everything I've done here on your system, I could have done with ChatGPT and gotten the same responses. And my answer is no, you couldn't. It is physically impossible because of the amount of relevant data, like your expectations of what ChatGPT can do in a generalized LLM versus the reality of what we trained our system to do, completely different thing. Will, this is like 3 years of me, just my experience alone, let alone your experience of emails back and forth, tracking best practices, all actually put into our models.
If you can get this done some other way, do it some other way.
Sure.
I don't care how you do it. I mean, if you use our system, use our system. All I care is that you get funded, right? That you get the outcome that you're looking for. I also say this, people are like, well, should I just use your system? Absolutely not.
Yeah.
Absolutely not.
Good point.
Here's what your utility belt of fundraising looks like. Okay. And I want to make sure folks hear this and they understand this. We have a tool, one tool, it's an investor matching tool that will help you find the investors that you don't know about. Okay. That's helpful. Now you're going to pitch them cold in most cases. Okay. Which is tough to do. That is one tool in the tool belt. The next tool in the tool belt is obviously any of your warm introductions. Now, the problem with the warm introductions, which everybody's always excited about, is that the probability that the people know the exact investor that fits your stage, your category, your location, etc., is probably pretty low. That's where I got burnt out. I was going through all of my warm intros and getting nowhere. And I was like, I don't understand what's happening. Like, these are all warm intros. Yeah, they were warm intros to the wrong people.
Right.
So again, the probability that your warm intros or your personal network happens to align with exactly who you're raising money from is often low. Okay. So, but warm intros are definitely an important part of the tool belt. The next part that a lot of people miss, and this is a great hack, is your advisory board. Now, most of you don't have an advisory board, and it should have been the first thing you set up. We'll do whole other episodes on how to set these things up. We're building a new product to build one for you, all this good stuff. Your advisory board is your ability to find 3 to 5 highly networked people that are ideally highly networked in the space that you're going into that can help make some of these introductions as well. So your advisory board becomes another tool in your tool belt of raising capital. Next tool in your tool belt of raising capital, and Ed, we talk about this all the time, other founders.
Perfect.
People don't think about this one. The way I got my best intros, or even my initial intros, were from other founders. By the way, people I'd never met before in my life. I'd reach out to somebody and I'd say, hey, you don't know me, I don't know you, but I could use your advice on this fundraising I'm about to do. We'd sit down, I'd explain to them what they're trying to do. And I said, hey, I noticed that you have 3 different investors that, kind of fit what I'm trying to do. Would you be willing to make intros? And 2 things happen that are invaluable. Number 1, they tell you do not want to talk to that person. They're a complete a-hole. You're like, whoa, okay, well, you just saved me. Right? They'll give you the inside scoop. Trust me.
Yes.
We'll be very honest, right? And so they'll allow you to avoid some people that could save your life on that one. But the second thing they'll do, this is the most valuable part, they'll say, here's what to say. Here's what their hot buttons are. Because I sit with that person in my board meetings all the time. I know exactly what to say to her. Her hot button right now is she has to see AI and fintech that has this kind of ROI, right? And you're like, I would have never known that. And so a founder making that intro, because they're a founder and they're raising, can tell you that intel that you need for a way different introduction. And if you're wondering why a founder would make the introduction, it's this simple. Founders love to help founders. We all do it.
We do it.
If you haven't been in this world, then you don't appreciate what that means. We love to help each other. The only place that I've seen this work as well is with veterans. Whenever I see 2 vets connect,
yep,
they've been through the same shared experience and they love helping each other because they've been there. That respect is there. The credibility is there. Same goes for founders. When they see somebody else going through the same thing, they're willing to help out.
Let's land this plane, Will.
Yeah.
My question to you, time-based. We already talked about expectation versus reality in terms of how much time. Will, at what point in time do you just say, hey, I need to shelf this for a while and work on my startup? Let me just share this wonderful nugget of advice that we got from our colleague, Ryan Rattan, our chief marketing officer. He taught me, which I never thought of, ask founders what their plan B is. Let's say the raise doesn't go the way you expect it. What's your plan B? Are you just going to shutter everything? Will, you talk about on the Startup Therapy podcast all the time, it's not startups that run out of money, it's founders that run out of money.
Yeah.
At what point in time do you say, I'm going to go work on that plan B? This is not something that's viable for me at the moment.
I am a very strong proponent that fundraising is always plan B.
Wow. Okay.
But let me explain why. And this comes from somebody who builds a fundraising tool. Theoretically, I have a financial incentive to say the opposite, but it's just not the way I feel. I do not feel like you have a substantive amount of control over the outcome of your fundraise because it involves other people, right? I do not feel that you have the control that would warrant fundraising being plan A. Now, it would be different if I was like, look, it's a mortgage. If your credit score and your income align, you're going to get approved. It just doesn't work that way. Yeah. I've seen people, you have 2 Ed with phenomenal ideas, go out and just come up totally empty-handed over a long period of time.
Oh yeah.
It happens. It's not that simple. It's not like, oh, I'm doing something in AI and everyone's getting checks in AI, so I'll get one. No, you won't. There's no guarantee that will happen. And so your sphere of control is very limited, frustrating as hell. I've been through it. I always say that I'm going to focus on plan A, which is whatever I can control, which is product development, recruiting, if there is any. There's different ways to get to recruiting. I can control my sales. If I can create any sales, et cetera, I can do services early, et cetera. I'm going to focus on everything that I can control. And while I'm going to run a coherent and well-disciplined fundraise, I'm going to recognize that the funding is what happens if plan A doesn't work. People do the opposite. Like, I'm going to fundraise, and if that doesn't work, we're done. Okay, I get that. I don't love that plan. What's your thought, Ed?
I think it's a perfect way. As we say all the time, the best time to raise funds is when you don't need them. So if you got plan A rocking, it's funny how investors experience that FOMO and they start offering checks to you, especially at those early stages. Now, there's a difference in terms of the prevailing advice out there. A lot of people say, if you don't get your fundraise done in 6 weeks in Silicon Valley, word spreads, you become pariah, you get blacklisted, there's a scarlet letter. Everyone, don't listen to that advice because that's for a very specific small subset of people who are already in the VC game. We're talking about, hey, I would love, Will, for every founder to come and say, you know what? I'm here to work on my startup, generate revenue, get that traction. I'm managing my runway. Meanwhile, I'm going to learn how to do fundraisers, plan B. And when the stars align, there's a confluence of events, that perfect storm, then I'll take the funding. But by then, I may not even need it. I'm bootstrapping. I could have the option to say no.
Here's what kills me about most fundraising advice coming from like prominent VCs, et cetera. The problem is the folks that often are listening to their podcasts, et cetera, don't realize that they're talking about a very tiny percentage of people, right? And again, I've been in that world, so I'm very familiar. For those of you that aren't familiar, if I'm talking kind of broadly and amorphously, here's what I'm saying. There is an upper 1% of startups in a community within there that operate completely differently than the rest of us. Okay. Yes. I just want to be very clear. They're wildly nepotistic. They kind of all have the same zip code, right? Like they're all coming from the same places. They're all either coming out of it. I'm generalizing a little bit, so bear with me.
Sure.
They're all coming out of Stanford, for example, or they're all coming out of Google, et cetera. There is a world, and I've been in that world, where those folks can raise at astronomical valuations practically overnight. And the advice that they'll give is wonderful, and it doesn't apply to you even 1%. Okay, I just want to be super clear about that. I'll give you an example. My old co-founder, Jamie Siminoff, started Ring, the doorbell company. And when Jamie and I were out raising, I mentioned there was one raise that I did that was kind of anomalous. Jamie and I raised our seed round in like 24 hours, right? Now, at the time, Jamie hadn't done Ring yet. So he had done a bunch of startups like I had. I'd done a bunch of startups. But we were a good team. It was a good idea at the time. And we raised that money. That said, neither of us had ever raised money that quickly before. It was a one-time thing. And even when he did Ring, I don't think he raised quite that quickly on those formative raises. I say this to say, Jamie and I were in that world at that time. Like we were in that 1% world, and things operated completely differently. If you're coming from Oklahoma, right? I live in Ohio, so I'm not knocking Oklahoma. If you're coming from Oklahoma and you're not in that 1% world, all the stuff you read about on Y Combinator generally doesn't apply. And it's not because they're poorly intended. Their intentions are fantastic. It's because they're talking about a world that you're not in. And it's important that you help decouple that.
I'm so glad you went there. And it just gives everyone an idea of where we're coming from and our intentions. This has been great, Will. So what's the first step? People have watched this video and we're going to be helping them, right? They're going to get support and everything here, depending on how you're a member with us. But on their own, Will, what's your first step that you tell all founders that they say, yep, I'm in, I'm going to do this?
First steps. I mean, Ed, as we're recording content like this, I wish the first step was, hey, watch our videos on how to set context for this so that you're not so far lost on, what the reality is going into the situation. But the first step is to get your message right. Yes. Most people have a high level concept of this is the solution, but they haven't really dug into what the problem is, the market size, et cetera. So the first thing we kind of force them to do, force being relative, is we say, here's exactly how you need to start thinking about how to convey this idea, right? It's like when I talked to the founder last week and I said, what's the solution? He said, analytics. And I was like, okay, that's not the way to communicate this, right? So we get the message right. Once they've got that right, once the message is strong, whether it's in their pitch deck, et cetera, we then say, well, let's figure out who to talk to, right? Let's figure out who's going to make sense to fit the bill for what we're trying to do. And then if all that works and everything goes the way it's supposed to, let's talk about what that outreach looks like. Let's find all the different tools in the utility belt to make sure we're maximizing our outreach and walking through that process.
Well, I also think one of the first steps, founders should start testing, just talking about their start with other people, peers, live people.
Yeah, man. Yeah. Because most startups in the formative stages, when they're talking about their startups, they're really bad at it. And this isn't a knock. This is all of us. This has nothing to do with the quality of the founder. They're bad at it because they haven't had reps yet. Like anything else in life, right? Like when you go play a new sport, you're bad at it. Not because you're a bad athlete, because you haven't played that sport yet. We just need reps on this. We need to talk to a lot of people. We need to hear ourselves giving the pitch and make, oh man, now that they said that out loud, that sounds terrible. And if you see our pitch deck breakdowns that we do on this channel, you'll see exactly what we're talking about. Great founders with great ideas that just need more reps on the idea, or on the pitch deck, rather.
If you get frustrated, you start to experience the trials and tribulations, the thankless, insufferable process that is fundraising. Make no bones about it. We know what it's like. We sat on your side of the table. Instead of losing hope, getting angry, or isolating, come talk to us and be open and vulnerable. And there are many of you founders, and I want to give you kudos to those of you in our audience right now. You have been so real with us saying, I'm struggling with this. I had this conversation. How do I interpret that? Versus, Ed, you're such a scam. And these accusations have flown around, everyone. We have complicated relations with social media. You've haven't delivered on any of your promises. I said, I can only promise that I will be here for you. We will be here for you, and want to encourage you in that. So that's what I'm going to leave you with. Will, final word to you.
Final word is this is a process. We do have a process that'll give you your best shot at raising capital. The last part of getting it over the line is your job, not ours. But our job is to make sure that when it comes time for you to go out and raise, that you have checked every box you possibly can. And if for whatever reason the fundraise doesn't work and it doesn't come to fruition, it's not because you did something wrong. You checked every box. You were best positioned to do what you had to do. It was the wrong time, wrong product, wrong audience, etc. But you were as prepared as you're going to be. And that we can guarantee.